Hi, everyone. I'm Mark Sir, Product Manager at Saving for College. And on behalf of the whole team here, I'd like to welcome you to today's edition of our advisor webinar series with Joe Messenger and his team from College Aid Pro. Last time, we told you a little bit about how to analyze and appeal your client's financial aid decisions. And today we'll help you understand how really to make that first college bill payment. Just one item of administrative issue. If you are a CFP professional, this presentation is approved for 1 hour of CFP CE credit. So if you'd be so kind as to add your name and your CFP Foundation ID to the chat shared with everyone, we'll be able to make sure that you get your credit. So with that, I'll go ahead and turn it over to Joe.
All right. Thanks, everybody. Mark, you got the easy part, man. You know, let me talk to these folks for a while, but I always love doing this particular session because I feel like this is a part of the process that you know, if we understand 529 college savings plans and coordinating all these things, now we're at the finish line. We have to actually figure out how to effectively pay the bill. So I'm going to go through some basically like strategy, like big picture, how to present this topic, and when you're working with clients, just kind of how to frame it up, because I think that's important. And also like going forward, how to give yourself some runway. So we're going to go through some strategy, but then tactics. So walking through details on some of the 529s, some of the hiccups we see, and then we'll get into demonstrations. So we'll show some actual schools and really how we utilize this, how the College Aid Pro system facilitates this conversation. So let's see if I can get in here first. So we should be seeing this. So welcome. My name is Joe Messenger. I'm one of the co-founders of College Aid Pro, Director of Advisor Solutions. And really, I want to start with this, and that is like, as we're looking at college and you're thinking about how to pay for college, we're going to get into some of the minutia today, some of the mechanical parts. But one of the concepts I've really been working with lately is, can we have a college crystal ball? So can we help see into the future, right? Because we're at the point of this process now where we have to figure out, how do we effectively pay for college? And that's not just 529s, it's assets, it's income, it's potentially some student loans. So we'll go through that. But the whole thing is, if you think about college, we oftentimes can do a good job saving, accumulating, but when we get there, the whole thing is figuring out, if we go to this school, what resources do we have? What's our costs? What are our resources? What's our delta? And if we go here, how do we pay for all 4 years of college down to the penny, including the resulting student loans and student loan payment? That to me is comprehensive college planning, education funding planning. So, you know, with a lot of it, so hopefully we're able to educate and empower you today with what that looks like and how we can do that proactively instead of reactively. So we just had College Decision Day of 5/1, but what we've actually found is schools are still taking applications. So as you're looking at paying that college bill, if none of the schools came back and were affordable, you can still be applying to schools. That 5/1 has historically always been decision day, but antitrust that came against the college admission counselors group basically says that, look, people can still shop after 5/1. You may ask them to commit, but you know, they can still shop. So if you're helping facilitate this conversation, again, this crystal ball that I'll show you how to facilitate this conversation, how to do this eloquently is important. You know, College Aid Pro, where we really focus on is ending the student debt crisis. And we do that really in a couple different ways, but changing the way America shops for college is really the start of that. So I'll walk through some pieces now that we're at the finish line, but really helping people shop smarter for college, giving themselves options is important so that we have an executable college funding plan at the end. So part of what we want to do is end the student loan crisis one family at a time. To do that, we need the advisors out there in the country to help with that. So we've built software that really demystifies financial aid, and we consider ourselves a technology partner, and an education partner. So we do a lot of these type of sessions. So for people that want to get, learn and understand how to do this, hopefully better. And then we educate a lot. And then you'll see at the end, can we help you give expert advice with confidence and ease? You know, this distribution, this decumulation of money, that is something that is kind of hard to articulate sometimes. So part of what we do also is help people attract, acquire, and serve clients in a more meaningful way around college. and repeatable and scalable way to do it. It's a critical part of what we're doing. Hopefully what used to take us hours upon hours, now with the right tools can be more impactful and be done in a matter of minutes as opposed to hours. So that's kind of what I had ready for this. And then I do want to, we do have a discount. So if people are interested in learning more, we'll put our demo link in there. This is the big sales pitch, but if you're interested, hopefully you get great information out of the webinar. But if you want to explore our solutions, we've got discount available through the Saving for College team. So hopefully we'll get a chance to catch up. So I'm going to go actually to this piece here. So the way I tee this up that we'll go through is really these kind of 6 critical steps for paying for college. And really, we're going to go through evaluating the options to cover your shortfalls today in detail. But when you look at prepare for the cost of college, right, we really need to begin doing that, preparing for the cost, having that college crystal ball, so that when we get here to the finish line, we're not surprised, right? Give yourself runway, give yourself options, because we can predict what you're going to pay out of pocket. And that is because we know how the process works, right? So if we've saved for college, kind of that 0 to 14, 15 phase, once you get to that freshman, sophomore year, your savings, not to say stop saving, but this is the time we really begin to think about college affordability, right? So we need to start to think about, sorry, let's get this, there we go. Preparing for the cost. So, you should have already discovered what your budget is. That's a college pre-approval process. Understanding it's not just savings. It's, what do we have from the parents, from the students, from any grandparents and outside help? How do we use the school's money first, then use our resources, and only take loans if we need to? Another big part of that is establishing schools, understanding things like expected family contributions, et cetera, because ultimately we're trying to get down to what is your net cost at school, because that's what we have to pay for, the net cost of school. So whatever they cost doesn't really matter. If we understand how to find schools with great discounts, ultimately they're going to tell us, here's what it's going to cost. I'll go through an award analysis. And then we have to figure out, how do we strategically pay for this bill? But all of these things, like I said, to give yourself runway, it shouldn't be a shock when you get there to understand what the net cost is. You can begin to plan for that net cost proactively instead of reactively. So that's kind of the whole idea of beginning this planning process, really freshman, sophomore year, because you have an idea of financials, which is going to determine folks' need-based financial aid eligibility. And you'll have an idea of a student's academics, which is going to determine any merit scholarships. So, and now with our system, we just did an analysis of all the awards that came in this year, and our scholarship projections were 92.8% accurate. So we were pretty proud of that. We think 92.8%, if you could tell a client when they have a sophomore or junior, here's likely what you're going to get based on your academics or your scholarships, that's pretty powerful stuff. So that's really preparing for the cost, going through the process, understanding how this works, and then guiding through the application and admissions process. It's really the financial aid process that we focus on, but making sure people don't miss things. You can still apply for financial aid for about another few weeks. So even if you didn't apply in the fall, understand if you want to go because you just found out. I had this case in point with a family. They had not filled out the financial aid forms. They were awarded some scholarships, but they didn't realize they had to fill out the financial aid forms to be eligible for federal direct student loans. So that's one where you can still file those forms today if you need access to those. And what I would suggest is nearly every family out there should at least consider the federal direct student loan for their kids. So again, like we're at this finish line, we're going to go through that. But if student loans are part of the process, I'll show you some of them are use it or lose it. So you really applying for that financial aid is critical, even when you're here at the finish line. And I got to say for financial advisors, when we talk about the financial aid process, just helping clients understand and how to fill the things out accurately gives you the opportunities for the most financial aid so that our bill is as low as possible. We're here to talk about how to pay the bill today, but it really starts with making sure we don't leave any stones unturned in the process. So hopefully this is helpful as we do that. And then we talked about analyze and appeal financial aid offers. So hopefully you were able to do that and potentially get more money. So that's part of this process. When they tell you what it's going to cost, Can we appeal and get more? And the answer is yes. Very successful appeals across the board. I think some of the highest numbers we saw from a great appeal, and I'll show you how we analyze those, was $12,000 additional free money over for 4 years. So that's $48,000. So again, like when we're getting down to how do we pay the bill, hopefully we've done all these things to get to a point where we can effectively go after it, choose the school, accept the award, right? But we need to, before we do that, we really need to analyze, see what it's going to cost out of pocket. And then ultimately, how do we cover the shortfall, right? Because this is where we're at right now. It's so paying the college bill has become about much more than just 529s, but I'll go through the mechanics there. But really, when you're thinking about how do we cover this shortfall, ideally, we try to minimize student loans. I don't think that's a secret to anyone, but doing this in a way that says, okay, what do we have in college savings plans? What's the plan there? But also, are there any other asset or income or tax strategy things we might want to put into play? A little beyond the scope of this today, but for example, high net worth folks, the tax strategy planning really is where you can get very tactical around how you pay this bill. Can we shift income to students in a business owner strategy? Is there an opportunity for a tuition reimbursement plan? Should that be one of the ways we plan to pay the college bill? Should we be thinking of gifting strategies to gift assets and utilize the student's tax capacity? These are important pieces of the puzzle, because at this point, what your financial aid is, right? If you are a financial aid candidate or not. So the important thing here is we're going to apply for financial aid, and we're also going to have to pay the college bill for 8 semesters. And I say 8, not 10. We're trying to estimate what this is going to cost. This is not a 5-6 year proposition. I want kids to and through college in 4 years. These schools that are graduating 20% of kids in 4 years, you need to do a better job. So as advisors, understanding graduation rates is important. I'll show you that when we're looking at assessing this and how to pay the shortfall. When we're talking about real guidance and advice through this process, we're at the point right now where we have to advise well on any distributions from 529 plans. We'll go through those qualifications. What about other investment accounts? When should we pull which? Also, and there's coordinating contributions from other family members. So understanding how would grandparent 529 plans affect the funding plan, right? Are there any tax credits we need to be aware of? And if so, if we have American Opportunity Tax Credit, how do we make sure we get the full tax credit? So we'll walk through some of those strategies, and then again, and evaluate and select the right loans. So having a smart lending strategy becomes a pretty important piece of the puzzle for us. Okay, so education funding, the process, and some of the savings vehicles. I want to just kind of quickly go through some accumulation, and then we'll focus mostly on decumulation, how to get the funds out wisely. Let's see. So when kids are younger, we're in that accumulation phase, right? We're trying to do time value of money analysis, getting it out there. What are we looking at? Investment returns versus inflating college. All of that stuff should be part of our basic financial planning software, which is great. But one thing that I see is you have to revisit this, is something I wanted to point out, because when we've met with families over the years, one of the things I found a lot of times was they would get to high school, they'd have a 15, 16-year-old, and they'd be way over invested. So it's something I wanted to point out today. We're doing this work. I think most advisors doing education planning, trying to project for the cost. But here's, when you're doing that, understand you need to revisit the target, right? So over invested, if you had a 17-year-old today that was in 100% stock that's going off to school in the fall, that wouldn't have been a great choice, because it's not, it's based on when they're going to need the money, right? So just something I want to point out as you think about the saving goal. Do the diligence. The majority of the plans now, I think even for a lot of advisors, are still advising either they're doing the age-based plans. Direct plans have become very popular, but even if you're doing an advisor sold, even if you are picking funds, make sure you're revisiting those, because that's the whole reason these age-based plans exist, is they want to make sure that the risk is appropriate for the time horizon. So, again, when we're looking for returns, and the other part here is once you get to that 9th and 10th grade, we're not looking to kill it with investment returns, right? We are looking to make sure, kind of preserve capital, make sure it's there when we need it. So just that idea of, make sure you're revisiting that allocation. So examples when we're saving and we're accumulating towards these goals, the reality is this is if you have a 10-year-old, right? And what's your target? So if we're trying to target what do we want to have in this instrument, this becomes important because I think it's important to build in flexibility into your college savings plans and goals. So, talking to families, giving them an idea, if we want to plan to fund a private college, this is what we're looking at, right? This is what we're looking at when we're out 7-8 years from now. Right. So that's these are big numbers. When we look at, can we get a rate of return? What's the savings goal? What do we need to put in to hit either 25%, 50%, or 100% funding? So what we would suggest is probably if you're going for private in particular, we know that they're discounting tuition over 50% in most cases. So planning for something like half of the cost in a college savings plan, and then considering other instruments might be something I would suggest. So when you're in that accumulation phase. And then just comparing that to a public, like, what do we think that's going to look like 7 years, 8 years out? What's our inflation rate of the school? And then what do we want to plan? What do we want to target? So hopefully those are just some helpful rules of thumb. And, you can all do these with time value of money. These are the kind of things you're calculating out. But my points here were, when we are accumulating, earmark things, even if they're not 529s, earmark that joint account, a joint, if you have just an investment account, earmark that and have it go towards that goal. And then it becomes like, if we are accumulating, and these are important to and through college as well, right? So 529 plan has obviously become the predominant vehicle that we're going to utilize. And Saving for College has some great resources on their advisor side of how to compare and contrast. The 529 plan has become probably the preferred vehicle by most, but there are certainly reasons to consider others. The Roth IRA, for those that qualify, can be a very effective tool to consider when we're where to put dollars, like I said, to and through college, if we want to utilize those. So as we look at these, I'd say 5 core things we might be dealing with, and we're going to talk through how to use these to pay the bill. But just understanding, like, when we look at how are they looked at from the investment flexibility, what about the tax, and then what about financial aid, right? So these are kind of the interesting thing when we're looking at how do we save for college, but now how do we pay for it, and guide them through this process. All along the way, we need to look and kind of, I would suggest, as we look at these vehicles, these are the kind of things we want to consider and weigh out. The 529 plan, operationally, extremely flexible. I'm going to go through that in detail. And especially over the last 3 to 5 years, some of the things you can do with it are even better. 529, some of them do get, as advisors, I think maybe we look at the investment flexibility. Obviously, you're limited to what's in that state's plan, but you can invest in any 529 plan. And I think big thing, tax efficiency as well. When we look at the 529 plan, understanding, is there a state income tax benefit to do so, and continuing to fund that throughout college to get at least up to the state deduction. I have a lot of clients in the state of Ohio. They give you up to $4,000 that you put in, you get a state of Ohio income tax deduction. So kind of like, why not, if we need those dollars to continue to flow through the plan. So if we understand investment flexibility, operational, we've talked tax and financial aid efficiency. So one you'll see on here that jumps out is the custodial account. From a financial aid standpoint, that one's not going to be great, but it has, you can invest however you would like. Great for gifting strategies. So one of the things that I say with all of this planning, we're at the point now where we need to understand, if we have our financial aid, we know what kind of scholarships we're going to get. Now we're again focusing more on just, okay, what's best now to get to and through college. We can save there, but we still need to be thinking, how do we effectively unwind these and get to and through college? Because if you're not a financial aid candidate, you didn't get any need-based aid, Now we can really look at where do we want to go? How do we want to utilize our custodial account? How do we want to utilize a taxable investment account and apply those resources? So I'll go through some kind of concrete examples of how we would suggest you might want to model these out. Okay. Yeah. So we talked 529, but so we can't do a paying for college without kind of going deeper on the 529. So I wanted to put together kind of, let's think through what all this applies to, and some things to be aware of. So the tax treatment, the withdrawals, if used for higher education expenses, there will be no taxation on that distribution. So, there's some notes here on, you have to be, they're state specific. So everything we say in general about 529s at the federal level, that state needs to adopt them, right? So some of the changes, many states follow what the federal government does, but for some reasons, the state is going to have their own, they're going to weigh in to say, do we want to actually have this, rule take effect? So that's important to know. States are a little bit different. For example, some states don't allow transfer of ownership. That's important when selecting a plan. So very few anymore, but just something to be aware of. But in general, higher education expenses, these days, it's pretty much anything you can think of that would come on a bill from the school. That's the way I think about it. So a school is going to bill you. And then even up above and beyond that, it can also go to books and supplies and everything else. So with tuition fees, books, supplies, equipment, it's become extremely a lot more flexible even than it used to be. One of the things you'll see noted there is the big changes are up to $10,000 per beneficiary per year can go towards K-12. So obviously we're talking about paying the college bill, but that is a new provision that up to $10,000. I'll go through a quick example. If you're working with folks to save and pay for private education, it's just kind of enhanced what the 529 can do as well. And then also the most recent thing that kind of came out is you can use up to $10,000 per lifetime, like per student, for qualifying student loans. So that's a big one. And even it stretches out even to a sibling. So if you have dollars left over, which a great problem to have, by the way, but if you do, you can apply those even to student loans on the back end. So I think that's, it's a nice new provision. You're allowed to do more with it on the front end. You're allowed to do more with it on the back end, because we kind of think of like saving for college, paying off college, those in those different buckets. I won't get into max funding because you guys probably know that, but you can really chunk money in and top things off if you wanted to do some advanced gifting. And even to, like, when we talk about advanced gifting and those things, we're talking predominantly about the investment side here, but there are still some prepaid tuition plans, like the private college 529, that we've, I really think they have some great things there from an investment standpoint. You're basically investing in the inflation of college costs. So even when you have folks at the finish line, if you know they're going to a private college that is part of the private college 529, you may want to consider, do we want to put some money in now and defray any future upticks in the cost? So you can work with them to say how many credits you want to buy. Grandparents like that strategy. They like the fact that the risk is basically, it's not riskless, but it's basically saying if college costs go up at my college or university by 5%, my tuition credit is there to pay for it. So just when you're at this finish line, because really with investments, we probably don't want to have a lot of volatility. So like I said, dampen, the volatility, bring those down to an appropriate level. And that private college 529 plan, which is College Well, they're one that it's just something to consider as a funding mechanism if you're looking at private colleges. So if you have questions on those, feel free to reach out, or I know we've got some events planned with them, but that's a kind of a unique one when we think of college savings plans, because that one's prepaid tuition. So just wanted to point that one out when we talk about the investment vehicles. Beneficiary changes, pretty flexible there, right? So if you're at this finish line and how are we thinking about it? Do we need to reposition some? Do we need to take some from another beneficiary potentially to pay? Like, understanding any 529 resources you have built around, those are important to be aware that, obviously we can change beneficiaries and avoid tax consequence on that. So that's become a really pretty easy process with most college savings plans to do that. So that's just, something to be aware of. Yeah, there's no income restrictions, investment options. I was talking about kind of you're looking at what's the menu. I would, if you haven't been using an age-based portfolio, or even if you have, you may want to look and make sure that allocation is appropriate as you go into it. And like we talked about, financial aid for the college savings plan is counted as an asset of the parent. Actually, even if on the FAFSA, even if the student owns the 529, it's still counted as an asset of the parent. So the highest amount that would be assessed is 5.64%. So that's 529s. And now let's get into some distribution conversation, and then we'll get into how to put it all together. We talked about, tuition, room, board, books, supplies, everything. You can use that 529 for. Public, private, religious, elementary, secondary, school tuition. That was part of the Tax Cuts and Jobs Act. Gosh, what was that? 2017, I guess, was the actual bill. But that's the one that is allowing for $10,000 aggregate per year. Beneficiary may be treated as qualified distribution for secondary school. So that's one. And then also to repay was part of the Secure Act. So that $10,000 again of qualifying federal and private student loans. It's a lifetime limit, $10,000. So if there's loans there, yes, you could use 529 plans to pay it back. The other expansion from that we've seen, which I think was some good ones, is the expansion to be able to use this with a number of, as long as it's qualified higher education, the expansion for things like apprenticeships, and doing things in the trades. Which is extremely important. So I'm glad that they've expanded that. So if you're thinking about how do we pay this bill, but also, the 529 plan, again, it's just increased in flexibility to be able to be used for secondary, be able to be used with limitations on some of your loans if you were to have them. So I think that's important things to know about. One thing that's not on here, but I wanted to bring up was what happens if we get a scholarship, right? So if we do get a scholarship, what does that mean for the 529? With the 529, you can show, you'll need to keep your records of this, but you can withdraw the funds and pay no penalty if you have scholarships. So why is that important? Because typically qualified higher education, you pull the money out, there's no tax, but if it's not qualified, you're going to pay tax and a 10% penalty on the growth. And that's a pro rata distribution of the funds. That's an important one as well. So, what amount is basis versus what is growth? It's pro rata. So 60, if it's whatever that is, if it's 60% basis, 40% growth, that's the way it's going to be potentially taxed. Hopefully there isn't, but if there were to be, it's a pro rata distribution. So you need to understand what that is. So hopefully that's helpful. I do get questions on that from time to time. So in the case of a scholarship, if you wanted to do a distribution, you would just verify, I've got a $10,000 scholarship. I want to take out funds from here. I want to take out $10,000. It's kind of a quasi-qualified higher education. And so you're taking it out and you're saying, this is, I want to use my 529, but I'm just going to take that money. So you're not penalized even if kids get scholarships. So obviously paying taxes, but if you had good tax deferral for a long time, I think that's still a pretty nice provision. And now you've got free money that you were looking to use the 529 for. I call that a win, with the ability, and that's kind of if you don't choose to either keep that for, the next child or, another sibling or something like that. So those are hopefully helpful on that end. We hit on that, I believe. Yeah, just be careful with compliance stuff. I want to give a quick example because when we're looking at using college savings plans, the distribution, this is specifically on K-12. So there's a limitation. So on qualified of $10,000 per. So this is just an example of 3 different kids. So if you have tuition expenses of $6,500 and you've got college savings plan distribution of $7,500, well, $6,500 of that would be qualified. 1,000 would be non-qualified. So you take the money out, you're just going to have to pay the tax. Another example, if it's $9,000 and you take out 9,000, that's all qualified distribution. And then if you have more than that you need to take out of the 529, let's say it's 18,000, you take the 18, 10's qualified, 8,000 is non-qualified. So, when you're looking at kind of how these numbers stack up, that's important piece. So it's, up to the cost of attendance at the schools is really where you want to think, like, how much can we take out of this 529? Like, what bill was left after financial aid is one way to think about that. So how much unmet cost is there at the school? That's what you can kind of legally take out. And from a 529 college savings plan, like a distribution strategy, high level, for the most part, I'm going to take out what we can each year, but understand, like, when do we need that money? Where is it coming from? Because you want to, it's not the worst thing to have money left over, but if you want to make sure that you're getting the dollars out of the 529 plan and all of it out, that's an important thing to know. Like, how much can you actually take out? Well, it's all the costs of the school minus any of their free money, which is grants and scholarships. That is the dollars you can take out from the 529 for that year. So that's what you need to understand. Is, like, if you look at the cost of attendance minus their true discounts, not student loans, not work study, but like, what is our remaining cost? That's where you can validate, you can take out from the 529 for the year. Okay. So 529, the savings plan, the challenges, I mentioned some of the state by state things, is something that I think are, you want to be sure, ask with the plan at the state on any kind of funny details you might see. If you need to see if the client still plans on using the funds for college or K-12 or later for student loans. So, like, I think some of the challenges, like, I would suggest you're going to, most likely for most cases, you're going to need the dollars for college. So be careful about draining it for K through 12. I suggest making those actually separate goal-based plans, because that way the investments are appropriate. You can have multiple 529s for one beneficiary. So if you want to manage it with different accounts, you could do that. So just understanding, like, as we have this expansion, you may want to just figure out, like, what are these buckets we want to plan for, and make sure that they're invested appropriately for what the target is. I talked about some of those other considerations. So this is one I just want to put in here, because before we get into kind of how to really put all this together, I think it's important to understand if lending is needed. We want to understand, what's the school costs, what's our budget, what's left over for all 4 years, right? So we need to understand that for all 4 years. That's the key here, because we're at the finish line. So planning just to pay for the next year, that's the, the most dangerous words in college planning. If you get in, we'll figure it out. If you're just figuring it out every semester, that's not a great strategy either. Because if lending is needed, you're going to want to understand from day one, what loans should we be considering? So the three primary types, well, there's federal direct loans and there's private loans. The federal direct loans for undergrad come in a couple different flavors, though. Federal direct loans for the student, typically referred to as the Stafford loan, but it's now really the federal direct student loan. But that one is a critical one, because there's no cosigner required. It's all in the student's name. And you have to fill out the financial aid forms to be eligible, as I noted at the top. But with these funds, the reason that we did a webinar called "Why Every Family Should Really Probably Take Out the Federal Direct Student Loan." It's reasonable interest, right? So right now, and these reset every July 1. In terms of the rates. So we'll be getting that information probably sometime in June. That'll be effective for the next school year. But the federal direct Stafford, the student loan, it's in the student's name, no cosigner. But here's a couple reasons to look at as well. Number one, if they're subsidized, meaning there's no interest that needs to be paid until after you're done with school. So that's pretty good. And then even if you don't have financial need, you can still get unsubsidized at a pretty reasonable rate. The key that I want to impress upon you all today is it's use it or lose it each year. These are the best type of loans you can get. So understanding what your 4-year outlay is important, because you're allotted $5,500 as a freshman, $6,500 as a sophomore, $7,500 as a junior, $7,500 as a senior, right? So if you need loans, so the temptation might be, we've got the money in the 529. We'll use that for year 1.5 for the first 3 semesters, then we'll figure it out. Where a better strategy to consider is, we should really be using those student loans in the student's name from year 1, right? So because they're use it or lose it, you can't go back and get them. So And the other thing that we see and we tell people is you establish tremendous credit by having the federal direct loan in the student's name. Even if the parent chooses to help them pay that off, you're still going to get a nice loan, or I mean, a really nice credit score. Because some kids come out of school, like if they never had a credit card, they just had a debit card that you're linking up jointly for them or something like that, they're going to come out with no credit. Whereas kids that come out, this is the good debt. I love that term, good debt. It doesn't really make sense to me, but like when you're thinking about how do we leverage these, there's a couple things with this. It's skin in the game for the student. A lot of people like that as a strategy to say every semester they're going to sign off on that promissory note, and we in the back pocket, we're going to help them pay those off. But we want to make sure every semester they're signing off on that note. And 27,000 is the max over 4 years. So it's a loan, and then for some parents also we suggest, if you look at modeling this out, if you're able to cash flow college, meaning, and we'll get into the cash flow conversation, but if you're able to cash flow college, sometimes people will say, gosh, we got to, back off retirement plan funding and, and so we can pay for this college. What I might suggest is if you take these reasonable interest rate loans, if you're able to do, let's say $500 per month instead of, and then you take these loans, well, you could just continue that 4 years after college and the loans would be pretty much paid off. Right. So hopefully that makes sense. Like if you take these loans and then you just keep doing the cash flowing you were doing, it would pay those loans off for your student in pretty short order. So, hopefully that's helpful. Again, you got to fill out the forms. There's a number of reasons you might want to consider it, have the conversation, educate and inform the parent, because you do get a lot of questions. And the other piece is that these come through the financial aid at the school. So, they're going to get their bill and they're going to say, how would you like to pay for it? With those loans, the last thing I'll say is you don't have to take the whole loan, just take what you need. So some people think, and parents will get kind of lured into that. Oh, I was offered, $22,750. I'll just take the whole loan. Well, let's make sure you actually want and need the whole loan every semester, right? So understanding and planning for that stair step up and understanding it's use it or lose it is really probably the biggest thing I wanted to impress upon us today. Because if we don't take those loans and we say, let's use our cash, and then we'll come back to the student loan conversation, we're going to end up with one of two things typically. And that's a federal direct loan in the parent's name, which is a Parent Plus loan, or you're going to end up with private loans. So the Parent Plus loan, it's quite frankly too easy to get. It shows up, and I got to show help your clients read the bill. And what they get from their financial aid award letter. And the reason I say that is because a lot of times they'll get the information from the school and they'll say, congratulations, we cost $50,000. We're going to give you 25. And here's, and we gave you some scholarships in there, but 25 is what's left. If you'd like to apply for the federal direct Parent Plus loan, click here. It's that easy. So with people maybe just not thinking through fully what that means or that it is a loan, because it is, I got to say, disguised as if it's a resource for school, which it is, but it's like, you got to be real careful, understand exactly what you're getting into, because these are pretty high interest rate loans. These are going to bump up all these pretty significantly. I'm venturing to guess here in July, as we've seen the rising interest rate environment. And then origination fees. So you're looking at it all in cost of over 10% in year one for the federal direct Parent Plus loan. The reason is because there's only one rate. There's no different rate, and it's probably around a 450, 500 credit score. So if you have people with, better credit scores, you really should look to the private market. And that could be, looking at things like a home equity line of credit done responsibly, obviously with your guidance, and then private student loans. Private student loans, if your need above the 27,000, private student loans, the parent could take them out or the student can take them out. If the student takes them out, there's a cosigner, so it kind of doesn't really matter. But those private loans, if you've got a good lender, don't. I'm not saying rule out the Parent Plus loan, but I am saying be very cautious because it really has become too easy to get. And then advising on private student loans, that's something you want to consider. So, but again, as you look at a smart lending strategy, understand that use it or lose it. Understand when we're coming back. Because this piece here, and really any of these privates, these are really just to fill small gaps. Hopefully, that's hopefully the case. So I think that's what I had there. Yep. So I'm actually going to hop over into here. Mark, I can take a couple questions because I'm going to do some demonstration. I don't know if there's some that have come in that I can address real quick. Just take a few minutes.
I think that'd be great, Joe. There are a few in the Q&A. I think it'd be great if we can go through a couple of those, maybe a few quick ones, especially, for example, one's here. Can you use a 529 for daycare? I believe the answer to that one's no. Am I correct?
As far as I know, yeah, it's got to be, yeah, so no daycare.
And then we have a question here. Who monitors the specific use of 529 plans? And the question, the IRS and the state tax authority. So he asks here, what is the real risk of being audited for this?
Yeah.
So here, I think we just would suggest caution.
Yeah. I mean, it is. So I should have said too, like when we're doing distributions, there's two ways that can happen. So stop share. So when you take a 529 plan distribution, the best way, I think, typically is to send it directly from the 529 to the school, because the school is then going to report that, and you're kind of like, you put that in your tax files and you'll be good to go. You'll get the form. The alternative is you can take that distribution and have them send you a check. And it is kind of on the honor system. So with that, I would keep the bill and keep the 529, make sure that it was a qualified distribution. But to whomever's point, who's actually monitoring this, it is, it's an IRS, and really a lot of it is if you were to get audited. So there is a little bit of honor system with the 529 college savings plan. But yeah, I proceed with caution. Pretty big penalties if you do get caught with your hand in the cookie jar. But hopefully that's helpful. Just that the direct costs of the college that they bill, paying those directly to the college is usually the easiest way to do that. And most of the time you do that right through the login. So having clients do that, creating the simplicity is what I would suggest as the primary way to do it. But then if you need to take it out and you've got expenses that aren't being directly billed from the school, just keep records. So that's it.
Excellent. And there's a good clarification question here for the Stafford loans. Is it automatic by filling out the desire to do so in the FAFSA, or does it come via the school's financial aid office? So maybe if we could just touch on the award letter and how that's accepted.
Yeah. So once you get your financial aid award letter, and then I'd say 90+% of the colleges now, it's done through the portal, through a portal. They're going to tell you, here's what you got, but that portal should mirror, and you will decide what I choose to accept or not accept. So obviously any free money, we're going to want to accept grants and scholarships that actually reduce the cost. But where you have choices is in the federal direct student loan. When you're in that portal, it's going to say, would you like it and how much? And it's going to break it out by here's subsidized, here's unsubsidized. So the maximum, like in year one, that you can get subsidized is $3,500, and then $2,000 would be unsubsidized. So that's the maximum you can get. The maximum you can get subsidized over 4 years is $19,000. And $8,000 would be unsubsidized. So it is important to know that difference, but it is done through that financial aid at the college or university. When you click that, they're essentially administering it. And when they click it, so the federal government goes, so if people qualify for the need-based side, that's based on the formulas the school is saying, but then they're going to make sure that money gets applied to the bill, and then it shows up in their FSA ID when they go in there. So that's kind of an important piece too. When you do take these federal direct student loans, when you do the FAFSA with that student, that FSA ID, that's also tied to their student loans. So they actually did a nice job, I think, of simplifying that. So once you get into student loan repayment and management, it is kind of fairly streamlined. It's all through that FSA program, federal student aid. So FSA IDs, that's going to stick with you for a lot of people for a long time. So they've made that pretty user friendly, I think. So.
Excellent. And then there were just a couple of more questions about qualified expenses for 529 plans. One is regarding off-campus housing. So that is a qualified expense from a 529 plan. But there's also a question here about transportation, for example, a car, which I believe is not considered a qualified expense.
Correct. A car is not considered qualified expense. It would be great if it was, but it's not. They're very, very liberal, but the car is definitely one that is not eligible.
Thank you, Joe.
Anything else now?
I think that's it now.
Okay, we'll get through, and there may be a little time towards the end. And I think some of these questions, as we see the visualization, will also kind of help answer these for you all. Those are some good questions. Let me share here. So this is inside the College Aid Pro system. I'm going to use this to demonstrate really like what we're getting at is cost of attendance, but really what's the net cost for these schools, and the list changes is the idea. And then the way that our system works is like your facts are going to determine what the schools think you can afford, but you need to actually figure out what you can actually afford. So we go through an exercise to create a baseline that will apply to all schools, right? So what do you have in 529 plans? What kind of contributions are you making? How long is it till we go off to school? And then is there any other pledged assets? So this is the conversation that we should have proactively, and then we revisit that and apply that to the schools, as I'll show here in a second. So other assets parents might have pledged should be in there as well. And then there's always notes for all this stuff as we go, and pledged assets. And then this is a big conversation right now, how to pay the bill. Well, let's talk cash flow, right? So really digging deep in like, what are you currently setting aside? A couple $100, great. What other expenses are going to go away that are not going to be in your budget once they go to school? You know, were they playing lacrosse? Did you pay for a band camp? So like, are there those things going to go away? And then what about the meal plan at the school? Because that's part of that cost of attendance number. It's part of the bill you're going to get. So it's just a conversation to help parents understand, instead of them taking $50 out of your fridge every week, they're going to have a $200 a month meal plan at the school. So again, it's things that can help parents figure out like, oh gosh, yeah, if we can cash flow this, that's big. So because between parents, typically if they've been able to save and the cash flow, that's oftentimes we're planning for a third, and then hopefully a third can come from either someone else or potentially some reasonable student loans. But that cash flow conversation, a lot of times cash flow is good for our clients when they're at this phase, because they're in their peak earning years. Coincidentally, if they'd applied for aid 10 years ago, been a very different story. They probably would have gotten some, but now they probably don't. But if cash flow is good, we just don't have that much runway with college. Right? Oftentimes, like, okay, we're here, but like everything we can cash flow is less we take out in student loans, right? So, but being intentional about the cash flow conversation, because there's two things that you can do. Number one, the schools have you can put it on a tuition payment plan. So they'll either say over 4 or 5 months throughout the semester, here's what's left, put me on a payment plan, right? So that cash flow conversation, it's seeing if the school offers it. With the payment plan, tuition payment plans, you stretch them out, pay as you go. So it's a big part of a lot of families' college funding plan that they may not be aware of. They're thinking, oh gosh, I got to take this loan and then I'll pay the loan off. Well, no, work with the school. You oftentimes can establish that plan with them. And that's, again, don't take the loan, pay as you go. For a lot of families that we work with, we simply use the 529 as the vehicle for that. So once we're to school, even through school, we may continue, but we earmark it as cash flow so they can kind of see that, okay, well, that's going to come from my check every month. We're going to kind of be front loading part of the next semester's bill so we can just pay it out of 529. So that becomes an important one. And then helping families understand, will they get the American Opportunity Tax Credit? At this phase of the game, one thing you'll want to understand is the best way, if your family qualifies based on income, educate and inform them. One of the things I say is if when you get that extra $2,500 in your tax, in your tax refund, that's for the next year's tuition. But things don't work like that in the real world. So just helping them educate, understand if they'll qualify. And then if they do, the easiest way to make sure you qualify is to use non-529 assets to hit the mark of $4,000. Non-529 assets. So if you spend $4,000, you'll get back $2,500 in the form of a tax credit. So it's a true tax credit, $4,000, $2,500. So hopefully that's helpful. Again, use non-529 to qualify. There is a pro rata calculation, but to keep it simple, either use a payment plan or cash flow in another area, just to make sure it's very easy to get the AOTC. So could probably talk about that for a while, but I'll kind of get through. And then the other piece here is when we're having this conversation about paying the college bill, we've determined what the parents can afford. Now we need to figure out what do we want the students to contribute, right? Because that's, are they expected? Do they have any assets? Do we expect them to work through school? And if they do work through school, will it actually go towards the cost of education? Is another important piece. If they do go to school, will they actually use it for education? Because $200 may not sound like much, but if you're trying to facilitate this conversation with parents and kids, hey, if you want to go here, this is the deal. You're going to work through school, and we expect you to put in $2,500 a year because we don't want you to have too many loans. My buddy. Sorry, my dog said hi to me. And then, so student in that conversation is important. And then grandparents, right? So we're at the finish line now. We're trying to figure out how to pay this bill. And I say it all the time. It never ceases to amaze me. People still can't talk to their parents about money. So, meet with successful 50-year-olds and we're saying, okay, look, we've got these dollars here. How do we want to apply them? Is it 5,000 or 5,000 a year? I don't know. Well, we're trying to create this budget so we can understand what our delta is at these different schools side by side, right? So, this one said 20,000, that's great. Okay, well, now we've can go off and begin to shop intelligently for school. And this really would apply, like, as we're at this finish line, this is our budget that we set out with. So how does that come through for us? So, inside the tool, you're going to have to understand, did you apply? Were you accepted? So we looked at some initial schools, but now we're at the finish line. So an aid award analysis tool is critical at this point because you want to levelize the playing field and potentially manipulate some things. So a school is going to give you, here's what it's going to cost, and here's any scholarships we got, here's any loans that were offered, and here's your remaining cost. So having a simple way to do that, so the default for Harvard, this is just what they publish, they say $6,000. You say, well, I don't think we're going to really spend that, so I'm going to put that in at $2,500. Okay, so that obviously that's our cost goes down a little bit. So let's, so you can manipulate any of these, that's important. And then the grant that was awarded and any loans. So in this case, we were offered unsubsidized, and that's what we got in the cost. So that's what we didn't get. We were not offered any subsidized from this institution. And that's an important one because it is institution by institution. If you looked at this particular one, here's what they cost. They gave us a nice scholarship of $25,000. But we, even with their unsubsidized loan, we're down here. This particular school actually awarded some subsidized loans as well as some unsubsidized, and you could choose to say, look, we're going to accept these or we don't want these, right? So you can determine that and again, help kind of guide the conversation along. So if you don't want to take them, you were offered, but hey, let's just take the subsidized. Let's see how that works out. And on down the line, some schools you say, look, we're not going to take it there because we don't need them. These ones are pretty much within our budget. So, maybe they offered them, but we just chose to take none. Right. So put that in there. So it's reading right off the award letters. And again, what we're trying to do is create a side by side. And I think the key is not just on a 1-year basis, but on a 4-year basis. So we're looking at these schools now, and I'm going to click down here because this is where we look at what's it actually going to cost. What was our aid? So what's the award kind of side by side, right? So we're able to see them. What's the remaining cost? And then also based on our budget and our initial plan here of how to pay for college, this is the borrowing analysis on a side by side. It's calculating a lot of numbers. So it's taking a second. So now we know, okay, after all of our aid was applied, we know our net cost, we know our budget, what's our funding gap at these schools on a side-by-side basis? Because big picture is important and then we'll dig into granular for the last few minutes here, but we're looking at these schools on a side-by-side basis, like, man, these are wildly different as far as like what our funding gap is, right? So, and this depends on the school, depends on the family, but ideally, like what our job is as advisors to give people visibility into what decision they're going to make. They may very well still decide they're going to Harvard come heck or high water, and we'll figure it out. And okay, well, let's figure it out though, because right now we have 114,000, and that would mean somebody has a $1,276 a month payment when we're done. Is that you or your student? Like, how are we, or do we want to apply more resources, right? Because we can sharpen the pencil and work with you. And one of the things I'll say is I look at these, and if people say, look, we really want to make Loyola happen, how can we do that? Like, look, can I get your buy-in that if we approach this, we got a pretty significant funding gap, but let me walk you through the ways we can pay this bill, because I don't want anybody coming out with $100,000 in loans. So if we can make this work in the context of your financial plan, what if we look at moving your retirement date back a couple years? If we can make it work, we'll make it work. We can cash flow more, right? So this is when we're getting into paying the bill. But like, again, high level visibility is really the key. And then you can go sharpen the pencil, right? So if I went to, Loyola University, maybe that's their top choice. And now I'm in here and we really have, I call it a sandbox, because you need to understand the net cost, but also, okay, here's our budget, but we're still coming up with a big funding gap even after we apply those federal direct student loans, right? So one of the things you'll want to look at too is we'll default to paying it evenly over all 4 years, but it could be something where it makes more sense to put more funding towards the back end. So like sometimes we might say, because of financial aid concerns, we don't want to use those dollars in the first 2 years. We want to use them in the last 2 years for the grandparents. Same total, right? But we want to use those in the latter part because of the way that it could potentially impact financial aid, right? So we're looking at this, like this is literally how we're going to pay the bill, is with these different resources, college savings, pledged assets, et cetera. Because really, I would zero this out because we got to pay that out. So really, this is a way to get really granular. What's going to come from 529? Maybe we want to front load some of that. What about these other assets? And if we're working with folks, we're saying, how do we chip away at this college bill? We may come in and say, look, actually, we said 10,000, but like we do have some stock options at work. And I think we can apply at 40,000 because we want to bring this dream school into play. Okay, awesome. So that's bringing down our cost. The other thing is to say, look, we've got these dollars here, but like 2,400 a year. One of the ways that parents can bring down that college cost is if they have the student commit to being a resident assistant. Those aren't guaranteed, but if it's a dream school, they're going, gosh, how are we going to do this? Well, maybe that's part of it. If you want to go to your dream school, you need to commit to working and paying. That'll pay for your room and board. So we could, potentially go in and offset that pretty significantly. You could go in and, whatever these resources are, you can apply more, so, and then cash flow. Okay, well, instead of doing 500 a month, what if we bump that up and we do something like 1,000 a month? Like, how does that look? So we're cash flowing it out 12,000 a year. Right. So we're applying more resources, not taking on more loans, because now we're down to a point where we're going, okay, high level, we started out at 90,000, but we applied some more resources. We're going to work a little bit more. We got this down to what I'd call not a terrible outcome. But what we want to see is, okay, we're still here. We're still at 503. And you're going to come out making 3,600. So we're talking about how to pay the bill. That's the topic of today. Once you get it back, if that initial budget that you've set, we've got to begin to put pencil to paper on the timing, the coordination, what assets to use when, cash flowing, if possible. So all those pieces that we talked about in the 6 steps and getting all the way to covering the shortfall, this is where parents say, oh my gosh, this is a lifesaver, because I actually can see how I'm going to actually pay this bill. And it wasn't just the 529. Right? It's really putting together the assets of the parents, the students' resources, grandparent help. And again, if a school, now we've got a much higher budget for this school because we applied more resources, but we got the loans down to what we think is a reasonable amount, right? And we can understand, like, well, how are we going to use these? How are we going to, if we do need additional loans, how do we map that out? Do you want to do the HELOC? Do you want to do a federal direct? How else do we want to fund, really refine and detail exactly how we're going to pay for college for all 4 years down to the penny, including the loans, the loan type, and the loan payments when you're done. So, because that's really the whole visibility. And like I said, as financial planners, our job is not to necessarily make the decision for them, but it is to go in and say, look, here's, on a side by side, this is the outcome here. Your starting salary isn't very much different. Is it really worth the additional money to go there? Those are the kind of value quotient conversations you're beginning to apply and look at all the different schools on a side-by-side basis. So that hopefully maybe have a minute for some questions, but this detailed look, again, it's the college crystal ball. You can project this, give people a realistic expectation of what they can expect, and then you got to come back and sharpen the pencil for each of these schools on a side-by-side basis with the real information, and really just help them understand their options, make sure that they know that there is an affordable path to college for you. It's just a matter of do we want to make it, and give them full transparency into what they're getting into, because nobody else is doing it. So that's hopefully helpful, how to pay the college bill. If you got questions, reach out. We'll send out some follow-up, but Mark, I'll take questions. But if anybody's interested in learning more about how we support people with software, but we also support people as like a back office. So if you're saying this is great, do you guys have experts? And the answer is yes. So if you want to, however you want to attack it, I just want advisors to know that we've got resources, tools, and even options to have you become a referral partner, depending on how you want to attack this. But we just want to be a resource regardless. So.
Thanks a lot, Joe. If we do have one moment, there's a particular question that came up a couple of times. So say the student or the family's got about 50% of the expected costs already saved in the 529 plan. There were some questions about strategies for when to use it. Do you want to just pay the first 2 years or the second 2 years, or to split it evenly? So maybe if you could just share some thoughts on that question.
Yeah, it's a great question, because it is like, if you've got half, and hopefully this was helpful here, how do you want to think about this for the family? And ultimately, because it's like, how do we want to pay it? What's the best way? Because maybe we don't spread this evenly over, and we plan to cash flow to build it up more for later. So it's not a one size fits all, but I think coordinating these, and the big one to me is cash flow. When you're working with that family, because if they can cash flow it and not have to burn all that 529, that's a consideration as well. Just, I think that's a big piece of this, is what can they cash flow versus what's in assets, and really visualizing that with them. Because obviously we want to, the big goal, mitigate the student loan, but be mindful, because like with cash flow, next level would be, we're going to do that each year. We're actually going to do that. We're going to run it through payroll. We're going to avoid paying the taxes and save you thousands of dollars by doing that. This 6,000. So, just understand the timing of each of these resources. How do we deploy them? It is important.
Excellent. Thanks. So folks, we will send the recording of this session with some follow-up materials. And we'd love for you to join us on the 26th of May. Joe will be joining us again as part of our 529-day panel. So if you'd like to learn a little bit more about your college savings options and 529 plan specifically, we'd love to have you join us, and we'll be sending out some promotion for that as well. So thank you, everybody, and have a wonderful rest of your day.
Thanks, everybody. Cheers.